The world of finance can often feel like a complex puzzle, filled with jargon and numbers that seem to have a life of their own. But today, I want to talk about something that, while it may sound a bit dry at first glance, is absolutely essential for understanding a company's financial health: the statement of retained earnings. Now, before you roll your eyes or think about switching to another video, let's break this down together. I promise it's more interesting than it sounds. So, what exactly are retained earnings? Simply put, retained earnings are the portion of a company's net income that is not distributed to shareholders as dividends. Instead, this money is kept within the company for various reasons. Think of it as the financial cushion that allows a business to invest in growth, pay off debt, or even fund research and development. It's like saving up for a rainy day, but instead of just saving, it's about reinvesting in the future. Now, why should you care about retained earnings? Well, for anyone involved in a business, whether you're an owner, an accountant, or just someone interested in financial reporting, understanding this concept is crucial. Retained earnings offer a glimpse into a company's stability and its ability to weather economic storms. When a company consistently retains a significant portion of its earnings, it signals confidence in its future prospects. This, in turn, can attract new investors and boost stock prices. Let's delve a little deeper into the statement of retained earnings itself. This financial document summarizes how a company's retained earnings have changed over a specified period. It records all net profits made, less any dividends paid to shareholders, showing how much money has been reinvested back into the business. It's a crucial part of a company's financial statements, sitting alongside the balance sheet, income statement, and cash flow statement. Imagine you're an investor. You want to know if the company you're considering investing in is financially healthy. The statement of retained earnings provides you with valuable insight. It shows you the beginning and ending balances of retained earnings, along with any transactions that affected this balance during the reporting period. This could include revenue and expenses, dividend payments, and other factors that impact the company's financial standing. But let's clear up some misconceptions. The statement of retained earnings is not a measure of profitability. It doesn't tell you how profitable the company is overall. It only shows how much of the profit has been retained. It's also not a cash flow statement. While both documents provide important information about a company's finances, the statement of retained earnings specifically focuses on the accumulation of earnings over time. And here's a common point of confusion: it doesn't include all profits. Only the portion of earnings that has been retained is shown. Any profits distributed as dividends to shareholders are excluded from this statement. So, if you're looking to understand a company's overall profitability, you'll need to look at the income statement alongside the statement of retained earnings. Now, let's talk about where this term comes from. The concept of retained earnings has been around since the early 20th century, evolving alongside accounting practices. The first use of the term statement of retained earnings isn't crystal clear, but it gained traction as financial accounting standards became more widely adopted. Today, it remains a critical financial statement, especially for publicly traded companies, providing insight into how much net income has been retained rather than distributed to shareholders. How does this all tie into accounting? The statement of retained earnings is intertwined with several accounting principles. It reflects changes in a company's retained earnings over time, serving as a vital measure of financial health and performance. It records net income or loss, helping stakeholders understand how much of that income is being kept as equity. Moreover, it provides insights into dividend payments, showing how much is being retained versus how much is being distributed to shareholders. This information is essential for investors who want to gauge a company's financial stability and potential for future dividends. Let's break it down with a simple formula. Retained earnings equals beginning retained earnings plus net income, dividends paid. This equation highlights how retained earnings accumulate over time. If a company starts with a certain amount of retained earnings, adds its net income for the period, and then subtracts any dividends paid out, it can determine its ending retained earnings. Now, let's look at some real-world examples to illustrate how this works. Picture John, a small business owner with a retail clothing store. At the beginning of the year, he has $50,000 in retained earnings. His store earns $100,000, but incurs $70,000 in expenses, resulting in a net income of $30,000. After paying out $10,000 in dividends, his retained earnings for the year would increase to $70,000. This simple calculation gives John a clearer picture of his business's financial health and helps him make informed decisions about future investments. Consider another example: ABC Inc., a successful clothing retailer. At the end of 2021, they had $500,000 in retained earnings. In 2022, they made $100,000 in net income and paid out $50,000 in dividends. This means their retained earnings increased to $550,000. This statement not only reflects their profitability, but also signals to investors that they are committed to reinvesting in their growth. And then there's XYZ Limited, A startup bakery. With $20,000 in retained earnings at the end of 2022, they made $50,000 in net income and paid out $10,000 in dividends. Their retained earnings for 2023 increased to $60,000. This growth is a positive indicator of their financial health and ability to reinvest in their business. The benefits of a statement of retained earnings are numerous. It provides a clear picture of a company's financial performance, informs stakeholders about dividend policies, and aids in long-term planning. It ensures compliance with accounting standards and increases transparency, which builds trust with investors. Moreover, it allows for performance comparisons over different periods, helping companies identify trends and make informed decisions. If a company consistently retains a high percentage of its earnings, it suggests good financial health and a commitment to future growth. So, how do you properly prepare a statement of retained earnings? Start by reviewing the financial statements, determine the beginning retained earnings, calculate the net income, and then figure out the dividends paid. Once you have all this information, you can calculate the ending retained earnings and prepare the statement. It's essential to ensure accuracy and clarity, as any mistakes can lead to misunderstandings about a company's financial position. Common pitfalls include mismatches between opening and closing balances, incorrect calculations of dividends, and neglecting to account for adjustments. The statement of retained earnings is typically prepared at the end of a financial reporting period, usually quarterly or annually. It's essential for providing insight into a company's retained earnings and how they've changed over time. In conclusion, understanding the statement of retained earnings is vital for anyone interested in finance, whether you're an investor, a business owner, or simply curious about how companies manage their finances. This statement offers a window into a company's financial health, revealing how much profit is being reinvested for future growth versus what is being distributed to shareholders. So next time you come across a financial statement, take a moment to look at the statement of retained earnings. It might just give you the insight you need to make informed decisions about your investments or understand the financial position of a company you care about. Remember, finance doesn't have to be dull. It's all about understanding the story behind the numbers.